My name is Andrew Stotson. I want to welcome you to the Valuation Masterclass presentation. Today, we're going to be seeing one of our bootcamp graduates' presentation. The company that he wrote a report on is LVMH, and we're going to basically see whether he thinks it's a buy or a sell, and we're going to hear his logic of how he gets there. This is a great opportunity for my students to demonstrate their skills and get real practice so that they know how to do fundamental research. In the Valuation Masterclass Bootcamp, you do 4 professional research reports. Throughout the whole bootcamp, you're guided by me, and it's all done under pressure. If you can withstand the pressure of the Valuation Masterclass Bootcamp, then it can build your confidence that you can withstand the pressure in the workforce. Well, let's get started. Enough hearing from me. Arush, are you ready to present?
Yes, definitely.
And why did you choose this company, by the way?
I always want to analyze a global company which has influence all over the world and work in such a multidimensional field.
Yeah, and this company is, interesting because it's got such a huge portfolio of different assets. So I'm interested. I looked at it a while ago. I haven't looked at it recently, so I'm interested to see what you have to say. So first, I'm going to share your screen up here. 1 second. So now the audience can see your screen, and what I'm going to do now is I'm going to exit here, and as soon as I exit, then take it away. And I'll be collecting questions from other students, from audience members, and for audience members out there, you have questions, make sure to put them in the chat, and I'll have questions for you at the end. So are you ready to rock?
Yes.
Okay, I'm exiting now. Make sure you speak loud. Let's go.
Hello everyone. Today I initiate coverage on a LVMH with an buy recommendation. I came to buy recommendation with an FCFE approach and I got a 12% upside from current price of £570. For LVMH, there are some highlights. It's in global luxury growth moderates as post-pandemic demand normalizes. We are going to see more about the company further in the report. Now, LVMH is formed in 1987 through a merger from Louis Vuitton and Moet Hennessy, which was founded in 1854. Very good group operating more than 75 spirits, perfumes, and cosmetics. Its flagship brands include Louis Vuitton, Dior, Bulgari, and Hennessy. LVMH primarily operates through a direct consumer mode. Now for the story parts. Global luxury growth moderates as post-pandemic demand normalizes. Global luxury demand has clearly shifted into normalization phase as major markets such as China, United States, Europe are experiencing slower growth. Company revenue has declined to a mid-single digit in first half of 2025. It has compressed by roughly 500 base points year-on-year, and EPS has fallen from 20% year-on-year. For its earning profile, LVMH earnings are increasingly concentrated on its strongest brands, with fashion and leather goods accounting for 49% of the group. These brands continue to outperform due to the strong brand equity pricing power. But company mainly lie in the cost discipline and skill support. LVMH continues to deliver superior profitability relative to global luxury peers, supported by scale advantage. LVMH has around 6,000 stores globally, which, with an operating margin, remain about 20%. Even its input cost and demand pressure rises in that demanding era. Its strong operating cash flows and conservative balance sheet provide flexibility to sustain returns. Now we are going to see LVMH in overall industry. According to the Bain and Atlangama, the global spending is around 1.4 to 1.5 trillion in 2025, with long-term growth moderating around 3 to 5% CAGR. LVMH, Chanel, Hermes benefit from brand equity and pricing power, and 60% of global luxury peers are influential people, which high net worth consumers remain the resilient and driving the majority of the value growth. Market size and long-term trajectory remain positive despite near-term softness. Now we are going to see the quarterly result for the LVMH. It's had declined in 4.5% year-on-year to 39.8 billion, weaker across key regions due to different factors we are going to see in coming slides. LVMH. Now we are going to operate on four constraints to growth on capital, operations, market, and people. Main constraint to growth is the market, as market dynamics represent LVMH primary growth constraint, as global luxury market has entered into post-pandemic normalization phase, with slower growth demand, aspirational consumer fatigue, and regional volatility, particularly in China and travel-driven markets. Now, major question can be about the capital, but LVMH is strong capital balance sheet with supported by operating cash flows around 13 billion and free cash flow approximately of 10 billion, and its debt is modest relative to its earning. As a result, funding availability itself is not a binding constraint on growth. Now, we are going to see revenue mix for the company. Revenue is generated through direct consumer sales, primarily company-owned stores, tightly controlled wholesale. LVMH operates 6,000 stores globally. Fashion and leather goods contributing 49% of group revenue and majority of operating profit. Now you can see the revenue breakdown by segment in 2025, with selective retailing for 23%, watches for 18%, perfumes 10%, and wine and spirits for 7%. Now, we are going to operate company on four different bases: fundamental, valuation, momentum, and risk. For the fundamentals, it's a rent average supported by high operating margins and strong recurring profitability. In valuation is score weak from peak levels, P remains elevated versus peer. On the momentum basis, its score is strong despite slow fundamentals. LVMH shows best-in-class share price momentum versus peers, reflecting defensive quality and earning resilience. Risk is moderate for the company as balance sheet leverage is manageable. Now for the competitive mode of the company. Overall, company has scored 72% among all these criteria, and among rivalry among competitors is scored 73, as it's difficult to compete in that large scale as LVMH operates. Now for the bargaining power and suppliers. Company has a strong bargaining power as certain raw materials such as exotic letters, geometrics, and high-end watches are can company operate and only supplied by certain suppliers. For bargaining power of customers, consumers can choose among several luxury brands, but true substitutes and equivalent heritage are few, and company operates in a certain niche market. For barrier, company has more in this area as enter this large scale efforts as LVMH operates. Now for the leadership and ownership. The current CEO and chairman of the company is Bernard Arnault and group managing director is Stephen Benacci. LVMH has a board composition in peace within Europe and France. Now company is mainly owned by 49% by top 5 shareholders and 2.5% institutional ownership. Now by we are going to analyze profitability growth of the company on different metrics. Profitability growth has remained solid but plateaued recently, moved to 3 in 2024 from past 12 months to 2. It's an increase year on year. It's a weak asset efficiency is consistently offset by world-class expense control. Asset efficiency remained at 9 across all periods due to capital intensity, while expense control stayed best in class as 1. Here you can see in detail about the following. Now, today hot topic is ESG. Now we are going to analyze company on the basis of ESG. Overall score of the company is 60%, and in different criteria we see in the slides. Does company have Company mainly operates on an eco and have LVMH Life 360 program, which mainly sustains its ESG goals. On social, it also scores 60% as LVMH has formal code of conduct and anti-corruption character promoting zero for tolerance for corruption. In the governance, LVMH CEO and chairman are the same person, which can influence its board decisions. That's why it is scored low in the governance part. Otherwise, all are good in the company. Now, here are the profit and loss statement for the company. Company gross profit has been increasing steadily for the past years and hope to doing the same in the future. Long-term investment. Company has mainly cash and short-term investment and doesn't need that much long-term investment as it's operate on low cash cycles. Now we are going to analyze company by its ratios. Current ratio. Company has around 1.3 of current ratio, which can hope to increase into 1.6 to 1.4. Cash conversion cycle. After the post-pandemic boom, company cash conversion cycle has been increasing steadily and average around 150 days. Company has very low debt, so debt to equity is around 0.6 and will decline in the future. Free cash flow. Company has been increasing in capex in the coming years as company is expanding and forming in the new markets. Relative valuation. LVMH trades at a premium versus France and Axis X Bank, but at discount to global markets. LVMH has a return on equity of 17%, remain well above France, ex-Asia Japan average and the global benchmark. For the PE, company has a negative PE for 2025 but on the forward 2026 PE, LVMH trades as 21x, broadly in line with France and global markets, but at a premium to Asia, ex-Japan. EPS growth is expected to recover to 5.5% in 2026. Now, for the valuation part, I drive my WACC at 8.8%. Primarily, LVMH has a strong and recurring cash generation alongside ongoing reinvestment needs. The base case valuation implies 701 for FCFF and 640 for FCFE. DDM dividend discount model does not apply to company as LVMH does not give that much dividend as of now. For the sensitivity analysis, the most sensitive company is R to the bank discount rate for 3.2% if the company had 10% upside or 10% downside. Now we are going to see the main risks of the company in the coming markets. For the main risk is rising tariff pressure as US tariff threats on European luxury goods, including fashion and wines, could increase prices for US consumers and pressure volumes. If costs cannot be fully passed through, margin may compress, adding earnings volatility during a weak luxury cycle. Now here are the disclaimer. Thank you.
Excellent. Excellent. All right. Let's get through some questions. Let's get to the first question, and maybe you go to the first slide. First question is from Lee. He says, there's been a lot of investor discussion regarding the succession plan for Bernard Arnault. In your view, does the current lack of a public successor create a governance discount on the stock price? In other words, when they announce the successor, do you think that the stock price will bounce or does it have no impact?
If the succession plans go through, it can have a discount on the stock as Bernard has been a CEO for almost five terms, consecutive terms for the company, and future uncertainty can create a discount for the company if the plan goes through.
And Moman asked, why is a 21.9 times forward PE considered an attractive entry part rather than a value trap? For instance, if we look at the share price, it's come down from a peak of about 825 down to where it is now at about 625 or so. What makes you think that the share price is going to go up from here?
I think seeing forward P alone on the is a misconception we can, but comparing it to its peers like Hermes and Chanel can give a broader view to the company. Like LVMH operates in a such a diverse market with an asset allocation in fashion, jewelry, perfumes, wines, spirits, create more for the company, and it's have such a brand value and equity, which justifies 21 PE. And according to the past performance, it's not at high. According to me, it's currently at trading at a discount to the future value and can go up to 12% in the future.
Here's a question from Puti-san, who says, why is the first story that global luxury is in a normalization phase, but EBIT or EBT and ROE is falling or negative year on year? My question is, how can I agree with the story that recommends to buy during, but you're presenting conflicting evidence? Yeah, I mean, it is pretty true that the ROE is coming down. We see negative recurring EPS growth in 2025. You could argue that it's a tough time for the company. Why would you say, that things are good or even normalizing?
Mainly normalization as companies face a post-boom COVID era. After 2022, its sales have skyrocketed, but now it's going to an average of 3 to 5%, which is good for that large scale and can provide a sustainable return in the long term. And for the negative ROE, companies facing currently a tariffs issue, and there's so much uncertainty in the market as currently US is the current biggest consumer for the company, and they are implying 25% tariffs on the company, which can create uncertainty. So market has discounted, and companies investing too much in the capital that can create a negative ROE. But in the long run, it will match to the average.
And another question that comes from Moment is, how much of the 12% upside is contingent on Chinese consumer rebound that hasn't materialized yet?
For the Chinese part, companies yet have a Chinese influence, but I think the company can rebound and create another source if the Chinese have difficulty in providing raw material for the company. And I don't think that in the long run they have that much problem, as they are mainly production happen in China, but can they are currently increasing in capex and diversifying their supply chain to increase to decrease their dependency on Chinese suppliers.
And beyond Chinese suppliers, I suspect a lot of the demand is being sold. A lot of the products are being sold in China. What about the demand for LVMH's products in China?
For the demand side, I don't see a decrease in the Chinese demand sustainably, like that can impact the future growth that much. There 1 to 5% decrease, but it can be normalized in the coming years.
Can we look at the inventory on the ratio page? Puti-san is asking about inventory, and I just want to look at that. Keep going to the ratio page. Okay. Let's see. 2027. Okay. Go back up to the balance sheet, to the assets. Let's see what Pudisan's talking about. Okay, so inventory, he says there's a huge jump over 2027 to 2029. Nah, I wouldn't say it's huge, but it's a jump. I'm going to leave that question for right now. Let's go to the next one, which is Faber says, from a relative valuation, if it trades at such a high PEG ratio, what's the incentive to buy? You know, you could argue that that there's not a super strong amount of growth right now, and the PE ratios are pretty high. What do you think? You know, why should someone buy now?
Basically, com- the mode for the company is its work. Like it's work in such a diverse sector, and it's an alone company which operates in such a large scale with a margin of 20% more with current tariffs and all that market uncertainty is still provide operating margin more than 20%. And I think the company operates at such a large scale of more than 90 billion pounds. It's a great thing only, and I think its growth will mature at around 3 to 5% annually, which
So
create
how
an
yeah. So how does it feel
continue.
to finish this project and graduate from the Valuation Masterclass Bootcamp?
Very excited about that. I'm nervous in the starting, but like it feels great after coming to the end.
Maybe you can describe like what's the difference between you today compared to when you first started. Let's go back to that first night of the Valuation Masterclass Bootcamp when we had the kickoff session. You went in a certain type of person, you came out a different person. What's the difference between you today compared to then?
Definitely, there's a huge difference in that. Like the first bigger difference I can like is that I become less camera shy than I was before. I'm able to present in front of everyone, have a confidence to present in that. Like, and I already try to present myself as much as I can. I always come forward to present on feedback Fridays. Always ask for feedback from women and Lee. That give me a huge boost in itself. And ask for the what can I do more, what can improve in self. All that feedback, valuation, learning have a huge transformation. And learning so much and doing so much on yourself in a short amount of time, that I think that's brilliant part of yourself.
And before you went into the Valuation Masterclass Bootcamp, you had knowledge of finance. If we look at your knowledge or application of finance, what's different today compared to when you entered?
Mainly, I think I what knowledge I have is like bookish knowledge, but in practical and applying in on theory, like how to apply that on the company, what can go wrong in the real world, learning all that. That's the biggest thing I learned in the boot camp. That's what I say. Like for LVMH, I learned how can a different things affect its valuation, how tariffs can affect, and when we value platinum groups, that's also a unique experience for me because valuing such a small scale company and a real estate and how things can work out for the company and what could go wrong. All these things in a real life, so much experience for me.
Fantastic. Well, I want to congratulate you on a job well done. You know, you put in a lot of time. You were always active in the groups and, you know, asking for feedback and taking on the challenges. So when you do that, you get the full benefit. And I can see from your presentation that you've gotten it. So my congratulations to you, Arush.
Thank you. Thanks to you.
Yep. Okay. I'll see you in the Slack channel. Meanwhile, I'm going to exit this and then I'll talk to the audience for just a bit and then we'll see you soon. Take care. Well, there you have it. Arush making his presentation of his company. And we can see he was doing LVMH. Remember, if you want to build a competitive advantage in company valuation, there's just 13 days left to the next boot camp. You'll get a $1,900 discount now, and that lasts for only 7 days. So scan the QR code or type BC23 live code at checkout at valuationmasterclass.com. I hope to see you in the next boot camp. And more importantly, I hope to see you presenting just like Arush. Let's build a competitive advantage in company valuation. See you there.